Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Clark Allen, head of ETFs at Horizon Investments, Thomas DiFazio, ETF Strategist at Roundhill Investments, and Stephen Burke, managing partner at ARS Investment Partners. We're here to discuss solutions-oriented investment products for today's marketplace. It is great to have all of you with us. Certainly a lot going on in the marketplace. Clark, let's kick it off. Give us a high-level overview of the current state of the ETF marketplace. What's driving the popularity?
I'm obligated as somebody that's in the ETF ecosystem to say liquidity, transparency, and taxes, but to be honest, what I'm seeing from end clients is the amount of innovation that's coming through the ETF wrapper. There's options-based strategies and other innovative solutions that are coming into the ETF wrapper. It's giving folks access to upside opportunities and even protection. In a market like this, having choice gives folks the opportunity to adapt to the climate and make sure that they have the solutions they need to help fulfill the needs of their portfolio.
Yeah, especially if you're looking, Thomas, for targeting specific nuances and thematic ETFs as an example.
Yeah, absolutely. Thematic ETFs have been we've seen that they've become a very powerful part of a portfolio allocation, just because it offers investors, one, a more active approach to the investment landscape, especially when stressors are continuing to emerge themselves. First, it was the government shutdown, which turns out is very transitory when it comes to market returns. But you still have a lot of geopolitical uneasiness, and you also have valuation concerns that are currently chasing the AI landscape. Investors are both interestingly enough, getting a little bit more risk on and chasing some of those high flying names, but also getting a little bit more defensive. And that really does necessitate, from an ETF perspective, an attractive, active approach.
Yeah, and we were talking about, Stephen, off camera before, just how fast AI and emerging technologies are moving, and you have to think about your time frames here as well. Are you an active investor? Are you looking at 3 to 5 years?
Yeah, this is an interesting environment. The rate of change has never been this great and will probably never be this slow again. I think Justin Trudeau had that quote, and I think it's really true, and we're seeing it in all aspects, whether it's in the changes in the vehicles we're providing like ETFs, or whether it's just the way the environment's going. So for us to differentiate, we're looking out 3 to 5 years at those trends. Well, we think the market is very short-term oriented, and probably too short-term oriented for a lot of people to build capital the right way.
Yeah, so let's talk about differentiation here for a minute. There's over 8,000 ETFs. What makes your strategy different?
I think one is, we move away from the crowd. So by looking out 3 to 5 years, we find the short-termism that's so prevalent in the markets today is really what's changing how people act, and it leads to, I think, bad outcomes. You don't build capital overnight, you build it over time, and I think the short-termism is doing that. So what we do is look at the big themes that drive capital flows out 3 to 5 years, and if you get the right ones and avoid the losers, you're going to win big. And that's really how we do it, step away from the market.
Yeah, and Clark, especially when you're designing investment products to be solutions-oriented, tell us about how you're approaching that.
Yeah, for us, it's not just about an individual ETF, although we think our ETFs individually have sound ideas and innovative solutions, but it's how do we provide a holistic solution for an advisor. Our distribution framework and who we distribute to is the financial advisors, and so it's about building model portfolios and customized solutions that use some of our ETFs and also may even use some of the competitors and folks that are sitting here with me, right? How do we work with partners to build a holistic model portfolio, something that has a long-term opportunity to fulfill financial plans? Again, for an advisor, that's not just for next year or even for the next 5 years, but it could be for the next 20 or 30 years. How do you build a portfolio that an investor can stick with? And so it's critical to have not only ETFs that we believe in individually, but also find partners that have complementary strategies that work together to help fulfill financial plans.
So how are you addressing, the concern around valuation right now?
Yeah, so I think it's actually a very good thought that I want to pull on from both Stephen and what Clark said. Longer term investing, and you're trying to capture structural trends in the market. So we have a GLP-1 and weight loss ETF, OZEM, and in reality, it's a really interesting way where you're trying to capture a trend that has actually been in place since 1975. The global population has tripled in their obesity rates since that year, and it's going to affect half of the population by 2030. So when you think about how can we play on these types of trends, it's playing on short-termism is is a difficult game. You almost have to take a longer term view and position your portfolio accordingly.
Which is so interesting because I'm starting to hear more the longevity theme come up. So when you're talking about thinking longer term, especially, we have an aging population here in the US.
Yeah, it's one that it can be very easy to move with the headlines of the market, but ultimately it's a very powerful thing with thematics. I mean, you can do it with AI, you can do it within the healthcare sector. It really depends on what are your investors looking for. Are you looking to get more defensive long term? Then perhaps you're going to go within the GLP-1 weight loss area because you're in a more defensive oriented sector. Maybe you're looking to get more risk on because you're seeking longer term capital appreciation. Then you're going to go the AI route.
Yeah, I also think advisors need to be mindful of how these products fit into portfolios as well.
Yeah, I think designing a portfolio and an asset allocation strategy, when you think about the world we live in today, so many of the products are the same. They don't move away from the sector weightings too much. They have the same top 10 holdings. You go through, most of the people are getting the same thing multiple times in their portfolios, and really thoughtful portfolio construction gives you complementary items that work at different times, but allow you to stay in the long term. And I think the way the portfolios are designed right now is there's too much of the same themes playing in portfolios. And when the market goes down, people really get hit hard because they're not diversified enough. And we don't believe in over-diversification either, but if your diversification is 5 funds that all have the same top 10 holdings, you're not diversified. So we think you have to find managers who go a little bit deeper and can complement either an S&P weighting that is getting them different exposures that are the future exposures, not the ones that worked the last couple of years. And I think that's the mistake people are making.
Yeah.
Can I pull on that for a minute? Because I think it's critical. It's not just different holdings, but also different investment approaches. There's different types of styles, whether it be options-based or active or tactical, risk management types of approaches, and diversifying across those tool sets gives you different paths, right? Some of those do better at different market environments and different times. And thinking about an advisor, when the market gets volatile, how do you give them a story that they can stick to and help the client stay focused on the goal of the plan, which is to stay invested? If the investor stays invested through the volatility, it's going to be a much better outcome for the long term, for their financial plan and for their future.
Yeah, and you also noted here that it's not necessarily what the products are called, but the need and how that fits into the client portfolio. Because we were talking about this off camera as well. Getting into alternatives, or what people hear, and it's a shiny object. So, as an advisor, you also want to think about the appropriateness for portfolios.
Yeah, we have advisors come to us quite often asking about alternatives or other, we'll say, topical strategies that are coming to market. And for us, it's not about what it's called, although that's what the salespeople would like you to think, but it's about what does it do for the portfolio? How does it fit and complement what the advisor already has in their portfolio and help drive better outcomes? You can show that. It's statistics, it's a little bit of math, and you can show, look, this strategy truly complements the other ones and it's going to drive a better outcome, whether it's helping a client stay invested, better upside, whatever it is that the advisor is driving towards. I think it's critical to just focus on the outcome of the strategy rather than the buzzwords that folks like to put around these strategies.
And even just to pick on that a little bit as well, I think that's really where you get the value proposition of an active managed style within ETFs here. As Stephen was also mentioning, when you're looking at your portfolio, there's potential for a lot of overlap. And so when you have an active approach within your funds, you're then able to be like, how can we challenge the current market landscape and really add value as a fiduciary for our client base? And then that's where you can, I think, really create a long-lasting product that's going to resonate with the clients and create that brand's loyalty and that fund loyalty over the long run.
How you bring something different too. And is the names the same names? Because most of the strategies, top 10s, look so alike. It's not much value being added. So adding that into your portfolio does nothing, really.
How active is active?
I think it can depend on the strategy. When we think of a thematic ETF portfolio construction, we consider 2 pillars: thematic relevancy, how much they are close to that theme, and then their fundamental proximity. Do they actually have money going towards those initiatives? And some themes are going to move a lot faster than others. If you think about AI, that'll be really quick and things are going to transition. If you're thinking about the weight loss and GLP-1, that's a lot more slower moving because you have clinical trials and you have to consider and wait for data to come in and out of the market.
Yeah, I mean, it was just so interesting. Even yesterday gold was down 6%, and all the questions. is it time to get in? Is it, is the gold trade over? When something like that, you have to think longer term, not just what the headlines are suggesting.
Yeah, I mean, we obviously we have also gotten a lot of questions from advisors about gold, right? What do we do? How do we incorporate this? And we think about it not just individually, but how does gold fit alongside? And if you were to think about portfolio construction, what is an appropriate size for a portfolio? Okay, advisor, your clients are asking for gold or crypto or Bitcoin. Let's just run some mathematical analysis and figure out what's an appropriate size for what you're trying to achieve. When you think about it in that construct, it's pretty easy to come to a number, and it's probably not what you think. It's much lower than probably what you'd imagine, because gold and Bitcoin are pretty uncorrelated and also maybe don't give you the return stream that you're thinking over any given period of time. As we've seen, Bitcoin is not a hedge. Just as much as everyone might think it is not a hedge instrument. It's a levered Qs exposure, at least at this point. And so as long as we all can agree on that, then you can then allocate to it in a thoughtful manner. We think that's critical.
It just seems like the landscape has evolved so quickly over the past decade, where you're almost conditioned for instant results. I mean, FOMO is a real thing.
It is a real thing, and in this environment, in our portfolio, we have in a 30-stock portfolio, we have this year alone, 6 stocks are up over 88%. And that speaks to how uncommon this year is. And we've spent all our time trying to trim them down to get them to the right size, but they're going to keep working in a lot of cases. So how do you play that? I think this was what makes this environment so unique. And the amount of capital that's still available to be going into the market, $7 trillion plus all the private equity money. There's so much money going to chase good opportunities that you actually have to play the market for taking the opportunities as they're giving you, but not staying too long at the party.
Yeah, especially if you're underperforming your bench, you're going to have to get involved in some of these names that have been working.
And if you chase, you're probably going to lose if you're underperforming. That's the other thing. You got to be moving to the next themes, not the last ones.
Well, I think that's critical from a construction perspective, because if you're having style drift and an advisor's using your strategy for, whether we call it GLP or something else, you need to stay to that. You need to stay true to who you are, because then if not, it's not going to serve the purpose it needs for the advisor.
Yep.
And that's critical. And as long as you can tell that story and stick to your guns, it has a place and it has a purpose in the portfolio, and it's uncorrelated with the other things, right? Which is critical.
That's why we use the themes, the 3 to 5 year themes, because it drives our whole process, and our investors know and our advisors know what our thinking is at all times. So that allows them to play it for what we are and figure out how to position their portfolios.
I want to get back to that FOMO, because if you look at where we are, compare us to 98, 99, 2000, and folks were scared of that. And I ran some analysis. I think we have still 100+% return from here to get to the peak. If you were to just, as a corollary, which everyone's like, could that really be possible? Well, just pull up a chart of the end of 99 and into early 2000. It could be possible. The returns are phenomenal. And what I think is different this time around is, yes, you do have some reverse SPACs and some quantum companies and others that aren't making money, but you have the 7 largest companies in the world just printing more money than some countries even get in tax revenue. I mean, they're not spending money that they're lending or raising shares. They're actually buying back shares and then continuing to spend money. So we think this is a pretty stable market, regardless of the fact that it's been what we'll call pretty fast and I'd say pretty aggressive in terms of the concentration, but I would say it's fairly warranted considering how large and meaningful these companies are to the world economy.
Free cash flow is a lot different than it was in 90.
It definitely was. I mean,
Yeah. Just to mention on what Clark said, we had conversations about that 2000 comparison as well. Technology was not a profit contributor back then.
Right.
Now, the Magnificent Seven contribute 26% to the aggregate index profits over the past year.
and what did the energy and finance?
Oh gosh,
that was
them back in. It's an incredible disparity that you see, and then you also have to consider that valuation. As much as we check our Bloombergs and our fact sets and to see where are our companies on a trailing and a forward basis, valuation is a poor timing tool. So you have to also manage that risk while not fighting the tape. And you have to be considerate of that balance there.
Yeah, and we saw that with a lot of the meme stocks, right?
Yeah.
I mean, had no business trading where they were from a fundamental perspective, but that's what the market had priced in. Price action, I guess, trumps all when you're thinking about it in that short of a term. In the last 5 minutes here, let's think about outlook. 8,000 ETFs. Is there still room to innovate?
I've been in the industry since '81, so I've seen the industry come up with new stuff all the time. So whether there's a need to, we will absolutely innovate as an industry. I think the issue is, at the end of the day, to me, is still buying stocks or bonds or cash, however you put whatever wrappers on. So I think you'll see more products. For us, it's really where's capital going to flow, and how can capital flow to get real returns in the environment we're going in with the high debts that we have in the global system, with all the problems that are out there. How does innovation win over the problems? And I think there's going to be opportunities. The problem is going to create more innovation, so you'll have more product. But for us, we think there's so much required spending that has to go on that if you just focus on the areas of required spending, you don't have to worry about the short-term vagaries of the market and the whims of everything. And you look at national security, you look at the productivity improvements, you look at the energy transition, you look at healthcare costs coming down and outcomes going up. Those are areas that you can invest in for the next several years and not really worry about, what are tariffs going to do today or tomorrow, because you can see where the outcomes are going to be. Yeah. So for us, we think there'll be more product, more innovation, but if you stick to just finding good valued companies that have good tailwinds, you'll win. Yeah. I think it's that simple.
And from a thematic perspective, as the market and the economy continues to evolve, more themes are going to
evolve. I mean, that's the best part about this market is that it's always changing. It's living and breathing. And so themes can persist for long periods of time, but also certain themes can fade and come back in and out. It really does depend on that environment. To mention on what Stephen was saying too, there's also an obligation, and we take it very seriously at Roundhill, to put on our lab coats and go into the back and say, how can we challenge the status quo of products that are currently out there, and how can we provide value to our clients? I think there's always room to innovate in that space, and that's where you can have a lot of fun as well.
Yeah, and Clark, we'll wrap up with you.
Yeah, innovation's not going to stop, and I think that's where advisors and clients need to, one, understand who they are, what they're looking to achieve, and then have partners. And that's why we have a consulting business, to help folks understand how to cut through the noise and work with all the product. There's just so much product, and that innovation's not going to stop, because it's stocks, bonds, cash, and options, and there are so many combinations of that you can put together to create innovative solutions, and we think push the bounds of what we can provide to investors.
All right, appreciate all of your insights. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.